Hi, this is Samrat, and I welcome you all to the Baseline Show. We do this every Wednesday at noontime EST. It's 5 o'clock in London, and it's 10:30 in India. So I'm going to start us off with something which we all love, which is the baseline song. And let's see some head shaking on the baseline show with with our usual suspects on the show. We have Keith, we have Mark Rimza, we have Sonal, and we have Andreas. And our special guest today is Ash Mohammed, um, who's the so yeah, do we have the baseline song? I think everybody loves it, so I'm just gonna keep playing it. Um, so we have with us today Ash Mohammed. He has been with us in the past on on the Baseline India show, and the very interesting thing is that he's few days back somebody pointed out to me that we should have Ash Mohammed back and we should continue the chat that we were trying to have on the Baseline India show. So Ash is the head of remote delivery and change oversight at NetWest Group. He wears multiple hats. He's also doing a lot of community work with NetWest's community initiatives. He's also on the board of another NGO. I believe it is a non-profit, right? Which is called Move On, and you also run your own podcast. So Ash, welcome to the Baseline Show, and let's hear from you what you do and also about your podcast.
Cool. Well, thanks for inviting us back. I was surprised when you invited me back after the first session, so that's always good to hear. Clearly, I said something of value. So, as you mentioned, kind of most of my career has been in banking. So, from doing transformation and change programs for payments and branch integrations and all sorts of good stuff, to more kind of commercial products and running current account books and mortgages and credit cards, even through what was kind of 2008 and all the fun that that brought us in the finance industry. And then the last probably 8 to 10 years of my career has been in various sort of senior risk roles in the banking sector, from payments to tech to more recently building out frameworks across NatWest Group. So quite kind of varied career in banking. And as you said, my kind of passion is giving back to the community, mainly kind of playing back to my kind of childhood. So I like to kind of, now that I'm in an opportunity to give back. So Move On is a Scottish charity, no Highlanders involved, Keith, unfortunately, but it focuses on basically families and youngsters who are just born in the wrong place, wrong time, deals with food poverty, homelessness, and then supports people back into education, employment, and to move on with their life. So it's kind of my passion, keeps me sane after a day at work, because sometimes these kind of strategic roles, it's difficult to understand the value you bring. So going and seeing people that you've really made a difference to is what kind of keeps me sane. So that's probably my intro, but thank you for having me back again.
Thank you so much, Ash. And you know about Baseline Protocol, and I'm glad that you're one of the early leaders who had agreed to at least have a chat about it. A lot of enterprise leaders, when they see the blockchain guys, they just go in the other direction these days. But and yeah, especially these days, it's November of 2022, right? Interesting times. So yeah, we've come a long way. We just last 2 weeks we demonstrated to our community also a simple reference implementation for baseline. So our core devs have been, they've been hands to keyboard all the time, and they've been doing great stuff. So we built some libraries, and yeah, we are now ready for demos. So that's something which is happening. We have evolved, our narrative also towards more of cybersecurity for the enterprise. Where you could say it's more of a cybersecurity protocol which is utilizing blockchain in a way for multi-party workflows, and secure multi-party workflows. I think that is something which is really powerful, and we've seen a lot of interest from senior executives to that effect. So what we wanted to actually talk to you about is today. in your role, over I don't know, 20, almost 20 years with
Yeah,
with the
I know I don't
RBS
look at
and
Samrat,
now
but yeah, over 20 years.
NatWest Group. So you know, we could talk about, how do banks and financial organizations in general look at systems, which are into the digital supply chain, and if there are any data silos that you see in the current scenario, in the current way business is done.
Yeah. So the short answer is yes, there are many, 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 many data silos in the banking sector, certainly finance. I think especially the UK and European banks, and so I guess some of the American banks that have been here a while, they layer on and they absorb other organisations over a period of time. NatWest and RBS originally opened in 17 or the 18th century, so older than the States in some cases. And so they've been there a long time, and over time, obviously, as systems and computing came in, then you'd absorb a bank, you'd absorb another bank, and slowly the banks would layer and layer and layer. So we use kind of obviously mainframe systems, which are our core systems. However, we've then taken on a product or a bank for the commercial enterprise or for a corporate enterprise, and suddenly you've got another product and another database, which then is feeding in and out of core databases. And the challenge that brings is mainly kind of flexibility and agility in use of data. And so, for example, if you've got a retail customer who's also a business owner, who's also then has investments, how do you kind of leverage all of that data to have a single view of these customers is always a challenge in a large organization. And I think in the UK, we hold somewhere in the region of a fifth of all current accounts, which is somewhere in the region of sort of 20 million customers. So just, it might not seem a lot, but in terms of lines of data, that's just ridiculous. You've then got inconsistencies with data fields, across different customer groups. Current account is looking for something. And some of that is driven by regulation. Some of it's driven by, what we're looking for in terms of how that customer is made up. And then you've got mortgages, again, very different data set, different parameters we're looking for. And you keep doing that across the organizations. And then suddenly before you know it, you've got, lots of inconsistencies. You've got lots of data where the same customer is multiple places. And then you find it difficult then to cross-fertilize, especially when it comes to products. So you may have, say, for example, you may have a number of commercial businesses on the books, and you're providing investment services for them, invoicing, salary pay, etc. But you've got none of the employee records or none of the employee business, but you don't even know how to access that because you've no idea what they look like. You've got tons and tons of debit card transaction data. You're talking, especially nowadays, each person is averaging between 5 and 10 debit card transactions a day through contactless and etc. So you multiply that up by 20 million, you multiply that then by a month, you've got massive rich data which tells you a huge amount of things. Now, utility banks, and I put NatWest in that bucket of utility banks, and you see a lot of the big banks, they tend not to leverage that data like Facebook would, or a Google would, etc. Because it's just not seen as currently comfortable to do that. Part of that is regulation. Part of that is because those organizations are not set up to use the data in that manner. And it's used to drive decisioning, but certainly not used to then drive income and further cross-selling. So multiple challenges when it comes to data, to answer your question.
Isn't it also true that it's like if you were to actually use the end consumer data, you're basically are exposing yourself to every for every violation with a 4% revenue penalty for every single violation, right? So the risk reward is just simply not there.
Yeah, and you're not wrong, Andreas, and they're referencing GDPR, which the threat is 4% of revenue. I've yet to see that fine imposed on anyone, even though we've seen many breaches. But the threat is there. And I think the other part of it is the reputational risks that comes with this. So obviously, kind of, you'll see in the last year, 2-3 years, Cambridge Analytica, all sorts of other examples where data has been misused. And when it comes to banking, trust and banking has to go hand in hand. If you suddenly don't trust your bank, you're certainly not going to put your money there. And so banks are very kind of careful and nervous about using that data for anything more than banking, because if it's seen as a reputational risk to the bank, then the threat of losing all the financial element certainly outweighs whatever income generate you're going to get from the data piece.
Yeah, because brands are certainly very, very much interested in that. And in fact, are paying premiums now even more so to consumers themselves if they make that data available to them, whether that's credit or debit card transactions for data mining. But since we're talking here about baseline, I want to, since we're talking about data and centralized data, honeypots, given the exponentially growing number of devices that are actually connected to banking systems and are becoming transactors, independent autonomous transactors themselves, and the fact that as we all know, but no one wants to admit, that every bank is compromised at any given point in time. They just don't know it yet. What's the strategy for banks dealing with a basically fully decentralized world of subnetworks that are all connecting, and that are not necessarily, and where the endpoints cannot be basically trusted, because you have to assume they're compromised?
Yeah, and I'm certainly not a cybersecurity expert, but our cybersecurity guys, it's what keeps them up at night. It's safe to say, and you as you said, it's the speed that it's growing, and there's lots of kind of still tooling out there. There's lots of kind of suggested responses to it, but it's the fact your vulnerability area, what used to be a nice simple circle, is now no longer a nice simple circle, and your threat vectors are not as obvious as you would have previously thought. And to your point, they're certainly not in your control. And that's kind of both from the devices you've mentioned, but also the fact of proliferation of third parties. And what used to be in back in the day, third party used to be the exception, and they'd provide kind of odd services. But now a lot of this sort of end-to-end customer value chain is provided by third party suppliers. We've got financial services who are buying their payment sort of functionality with a third party provider. So suddenly you've got material elements of your banking journey now provided to you by a third party. And so that creates a massive risk when it comes to, anything cybersecurity is certainly one of it. Resilience is another big one. And we've certainly seen through UK and European regulators the focus on resilience, especially on customer value chain, and how you then give yourself comfort that if that payment provider was to fail, then what do you do? And if the answer is we would not be able to provide the service, then there's very little patience by the regulators with those responses, which then becomes very expensive, because then you're building parallel functionality, and then you're managing parallel functionality and all the cost that comes with it. So it is a problem.
Yeah, because the compromised credit card and debit cards, the source of that is primarily third-party payment processors, not banks themselves. Yeah,
and this is where you've got a lot of the sort of the controls, so to speak, in this space are all about behavioral biometrics. You've got some of the profiling tools are now pretty intelligent, and you'll see the more, and this goes back to the data point. One of the reasons we get approached quite a lot by external third parties is because we've got years and years of data on debit card transactions and customer behavior. So it's a gold mine for someone who's now building a behavioral tool And so if you're trying to do, fraud profiling tool, it's as intelligent as knowing, how you swipe your phone up, knowing which page you start with and how you go. Do you go left to right, right to left? It looks at so many different data points that you can start building a picture of how a customer will normally operate beyond the simple thing of, I'm not likely to buy a hat at 2 o'clock on a Sunday from Florida. That used to be old school, obvious stuff. Now it's far. Sorry, Keith, that was not directed at you, by the way. There's some lovely hats in Florida, but it's more just the fact that it's behavioural. So there are kind of controls, so to speak, around being more intelligent about when the fraud occurs. But that's reactive. I think there's an acknowledgement at the moment, because we don't have virtual PANs out there yet. There's the functionality is there, but it's a bit like when contactless came out, and there's a delay then from behavior, from mindset, from infrastructure before these things get taken on. And again, recent trip to the States, still using MagStripe in the States, which blows my mind every time I go to America. It makes me very nervous when I go to a restaurant and someone takes my debit card away, and then 3 hours later, because of the tip I've put on, the transaction goes through. Now in the UK, you just wouldn't do that, because someone would be worried that you've taken the card away. So we know that that's a massive gap, in the sense that someone sees your card, it doesn't take you 2 seconds to take an image of the card, and until we get to kind of virtual PANs being more naturally used, fraud is going to occur. So then most financial institutions will have a fraud appetite. They'd expect a certain loss, and the losses are in the hundreds of millions, but they'll have then reactive strategies to say, how quickly can I stop that loss, and how quickly can I turn off that tap when the fraud occurs?
So another question, and this comes sort of like to bit of the heart of baseline, which is the multi-party coordination under zero knowledge, as agents start to proliferate, right? As simple as I do, my Alexa is buying stuff from Amazon. How do you know that this is not a fraudulent transaction, that hasn't been compromised because my phone has been compromised and therefore the Alexa app has been changed? There's no way of assessing that as trust is being delegated to agents, autonomous agents that you cannot yet have a trust relationship with, unless you're putting the appropriate functionality in place to do so and give them identities.
Yeah, I mean, it's a good question, and it's a current litigation mire. And I know there's current conversations in various places around where does the blame fall if that does occur, and there's a as you said, if you can't trust whether it's Alexa or Siri or somebody else, or it's an autonomous device which is somebody transacting on your behalf, or it's been hacked, so to speak, and initiates the transaction, then at what point is who at fault? Because when the fraud occurs from a banking perspective, the bank carries a liability to a degree for losses to some point, depending on how it's occurred. And third-party losses at the moment, the regulators expect the banks to refund customers, because that's the approach they take, because they don't see the customer at fault. But at some point, banks will kind of say, well, hold on a minute, why are we left holding the can all the time when the exposures happened in something that's outside of our control, in that instance? So that's a kind of an ongoing discussion, which I'm not sure anyone's got a clear kind of view on who should be and where it should sit, because it's quite clear if it's a banking app and where there's a fault, but it's not so clear on these other types of devices.
And you know what? In fact, let's try and segue the discussion more towards, let's say, our digital supply chain. So, those were the kind of narratives that we intended to discuss here. So, and find out what would be the roadblocks or in a positive sense, let's say considerations to keep in mind. Let's say if let's say a bank or a financial institution was going to adopt a system which utilizes baseline protocol, or anything for that matter which is facilitating secure and private multi-party coordinations.
Yeah. So I don't think, I think generally the principle of improving security and improving the risk profile, I don't think anyone's going to say no to that. I think that's not usually the challenge. I think there's a number of things that, because, me and I'm sure banks in general, we're approached very often by people with magic pills to fix all sorts of our woes and problems. And there's a number of things that kind of normally trip them up. So the first one is generally integration. These things are great ideas, and then you suddenly come across a bank with multiple data sources, legacy data systems, lack of API connectivity, all sorts of things that a modern sort of innovative product is almost assuming is there. And then they suddenly come up against, infrastructure that's ancient. And it's kind of like, you're trying to drive a Formula One car on cobbles, and the thing just kind of collapses immediately. And so that's kind of our first challenge. And we see that a lot, people kind of come with all sorts of solutions to our problems. The second bit then is the breadth of the solution versus the risk we take. And I think sometimes that's just not clear as to how the solution is going to improve your risk profile versus there's some risk over here that you're now taking on. And I often find that either it's not clear because it's not understood by the people providing the service, or it's not clear because it's never really been tested. So you don't necessarily understand, you haven't risk assessed it. So you don't understand in situ what risks it could materialize. But I think principally, I don't think anyone's going to say no to something improving risk, but there's an element of proving it, testing it, showing what it does to your risk profile, how it kind of, improves versus what it creates. And then the last probably thing is just, we talked about regulation. Unfortunately, banking is highly regulated, and anything and everything, which includes whether it's supply chain, whether it's data, whether it's resilience, regulators, certainly across the UK and Europe, are very, very kind of firm and clear on that. And so that's the other part, which is, what does this do in terms of that value chain? How does it improve resilience versus does it create another dependency from a supply chain, etc. So there's probably a number of kind of questions, if answers were provided, would give people a bit more comfort to take the leap, so to speak.
Excellent. So we are working on those questions. Thank you very much, Ash, for those perspectives. And in a general sense, what's a bank thinking or a financial institution thinking when they look at a supply chain and they say, what, we actually, there are these few pieces of information which are still missing from a transaction that we're seeing, and
Yeah.
And hence, there may be an opportunity missed, or let's say that there are additional costs for establishing trust, or there's reconciliation which is happening. So
Yeah.
do you see those kind of pockets as well?
Yeah, I think so. I mean, back to that kind of culture. I mean, banks can tend to be very nervous, and I'll put banks in kind of two sections. You've got kind of what I would consider to be utility banks, which is banks that have been around there for more than 15 years, versus the more kind of, fintechy type banks that have been around for the last sort of 15 years. They've got very different appetite when it comes to supply chain. Traditional banks, as we'd call them, tend to be very nervous about sharing core services to supply chain, whether that's kind of anything to do with the payment journey is usually one, very nervous. Anything where data is externally shared is another, and anything where kind of hard coding or coding is exposed to a third party. So they tend to be kind of the three things that sort of more traditional banks get nervous about. Whereas you'll find the more kind of fintechy banks, they'll just take that in their stride because they probably built themselves with multiple sort of sections, very Lego-like. And therefore, a lot of fintech banks, will use the same bank-in-a-box provider. They'll use the same functionality when it comes to, debit card authorization systems. And so they'll be quite happy to farm out those services to supply chain, because that's just the way how quickly they get set up. Because setting up a bank and building all the functionality in-house is very, very, very expensive. Keeping it maintained, even more expensive. Aligned with the regulator, even more expensive. So unless you've built that infrastructure, it's hard to kind of come into the market and build that. So people tend to outsource that. And what banks are starting to do now is start becoming the supplier almost, rather than being the recipient. So they've got decades of experience in payments, right? So you've got that, you've got the credibility. What they haven't got is the ability to provide that as a product, and to go, right, we've been doing payments for hundreds of years. We're the payments provider for the government, so you can trust us right now. Imagine you could sell that product, and imagine you could provide that product to a new bank, a John Lewis or a Walmart, who suddenly go, right, we want some ability to do payments through their apps or their end-to-end journey. So suddenly you've got banks who are becoming the supplier. The other thing, I think, your point about kind of data and how you get access to different data points and how that feeds in and gives you a bigger picture. I don't know if you're familiar with embedded finance, but embedded finance is now the other big shift in the financial industry. So if you go to most places, you don't necessarily are aware online you've switched to a different supplier. You just go and make the purchase, and then someone in the background, whether it's kind of like Apple, PayPal, Klarna, all sorts of others, they're embedded in the journey. So you don't go somewhere else and get the money and come back. It's all in there. And so banks kind of are scrambling now to get on board with that. And because otherwise they end up just being the infrastructure, and they lose where the customer value is, which is the point of transaction. That's where your value is, because that's the thing you see. And that's where the income is. And so if you suddenly don't see that data, but you just see the end bit, you don't necessarily know what period along that value chain did you lose the customer. What opportunity did you miss along that value chain that you could have taken because you've got the product, you just for whatever reason didn't market it appropriately, you weren't building the journey appropriately, or you didn't kind of expose yourself to that customer at the right opportunity. And that's a huge valuable piece of data if you could see that. But it's difficult to see because you're then having multiple data sources across multiple suppliers, third parties, all coming in one place, which then tells you, here's all your missed opportunities for these customers. Here's all the missed opportunities for these journeys. That becomes quite valuable, but not sure how easy that is to get.
So one other question that I had, and this is sort of like moving, partially away from the retail side and more to the core to like banking around financing, and then subsequently also derived from that in the capital market where banks are active. The lack of verifiability of the underlying data in the instruments is a significant issue, right? It's like when I apply for a mortgage, I have a lender in between that basically is just a middleman between a bank, right? Unless the bank provides the loan itself, but I need to reveal a lot of sensitive data to that lender, and I have to trust that lender is able to manage that data appropriately, which very often is not the case.
Yeah.
So, do you see that there is an opportunity for banks to step in and cut out those lenders, especially for consumer loans, not necessarily large ones, but smaller ones, um, uh, uh, as well, where you don't necessarily have to provide. So if you were to use the concept of like zero-knowledge proofs, right, where where you say, hey, I need to see your banking statement, I need to know whether you have over 20,000 pounds in your bank account, or you have it's like you have steady income, etc., etc. But that means I have to reveal data that is enormously sensitive.
Yeah.
Right. Do you think there's an opportunity for banks to say, well, actually we don't want that data as long as you can provide us with proof of correctness, then that's fine. Right. So basically a proof, yes, I can prove to you, yes, that my bank account is over 20,000 pounds.
Yeah. So short answer is, would that be valuable? Yes. So there's a number of various initiatives that are going. I've certainly seen plenty of fintechs across Europe trying to do something similar, calling it kind of digital ID and various versions of it. And so at the moment, what they're focusing on, obviously, if you're a customer and you just want to join the bank, we'll need your proof of ID, we'll need your passport, your driving license, all sorts of, as you said, personal sensitive information. And as people are becoming more kind of acutely aware of their data and the value of their data, people are less likely to share that data, especially kind of, there's a definite generation point on that. And so people are now producing kind of digital IDs where they're effectively saying, so I'm Ash Mohamed, I provide my information to this digital ID provider, and I provide it once, and then they create a digital passport for me, which has all that information in there. And then when the bank says, I need to validate you and I need your proof of address, I need to know your ID, etc., then that acts as validation. The challenge, as always with these things, is legalities of fraud and identity theft, and who then is at blame, at fault for that. If the thing that's carrying the digital ID says, I confirm this person's income is $100,000 a year, and they were the ones who were tricked, and then we take give that loan to that customer based on 100,000, and that loan then fails because they really don't earn 100,000, they earn less, then you suddenly get into difficulty because you've relied on that information of that third party to make that decision. And now that loan has gone into default, who's at fault? And so it's things like that which make people very nervous about sort of outsourcing data decisions like that, because ultimately a regulator would not go to the third party. A regulator would go to the bank and say, I couldn't care less who you used. It's your responsibility to do that. And so banks therefore become very nervous about that, and they want to see the data and they want to validate the information, and then they want to be able to track that. Otherwise, they are outsourcing that risk. At the moment, it's too big a risk, and banks don't necessarily trust that that's going to be correct or etc. So that's the big kind of blocker at the moment, I would see it as. Sorry, Andres, you're on mute, I think.
So it's more of the that the data that is used is not necessarily trusted, right? So it's like you even though you don't, if I present to you a bank statement with my name and address and the banking history, then what? It's like it doesn't mean anything.
Yeah.
Right.
And
it's like
yeah. And I think, and I don't disagree, and I think that's my point about, but the bank takes that risk. That's the difference here. You're outsourcing the risk here. So part of what, especially when it comes to lending in the UK, generally speaking, you'll hold the current account with the place you've got your mortgage. And so if you said to me you earn 100,000 well, we'll be able to validate that because we'll see your salary coming in. So there's things you can kind of validate because to get a mortgage in most European banks, you'll need to hold some level of current account, transaction account with them, so they can validate your address, they can validate your ID, they can do checks like that themselves to make sure that what you've said is true. But if you're 100% relying on a third party to have done those validation checks for you, then that's a huge amount of trust you're putting in a third party that's accurate. Whereas the third party is not carrying the risk. If that's fraudulent, you still carry the risk. And until that changes, I think banks are going to be very nervous about that.
What if that third party is another bank? So it's like the question here is again multi-party coordination under zero
They may be related to a
knowledge,
bank,
right?
actually, not maybe directly, but maybe indirectly they may be.
So
Yeah.
I can prove to you that I could prove to you in zero knowledge that that I have a checking account with a balance of over $100,000 if you knew that the digital signature that has been validated belongs to, or that identifier over the signature belongs to a bank, and that the key that was used for the signature belongs to that bank, which happens all the time in interbank transfers, right? So it's just that you don't get to see the data of the individual, right? The underlying data. That's the key thing. There is a trusted source, right? But the data is fully obfuscated. It just says there is, yes, this individual, has a bank account with this bank, and it has over £100,000 in it, right? And that the bank exists. It's trusted. It's well regulated, right? It's like you won't get anything more than you would get if you actually, saw an actual bank statement.
Yeah, I think for things like opening up an account, I think I don't see that being too material an issue because we currently go to Experian or Equifax today anyway, so we're kind of going to an outsourcing to validate it. So I think the opening an account is probably less of the worry. It's a lending decision is where it gets complicated, because lending decision then also says what's your outgoing, what all sorts of other financial information is required beyond just the basic information. But I think if you had something which said that this customer's approached you and they bank with Citibank and they've been validated as a customer and all the information you require is being validated, can you just onboard them? I think if there was, as you said, trust, which would need to be underpinned by some minimum control environment, some minimum levels of rigor, because everyone would then need to be equally as good or as strong in their control environment, and you'd have to have someone then who just makes sure that's done consistently, because otherwise, what if bank A has a weaker control environment than bank B? What if they've had a major control failure on their data 6 weeks earlier? How do you then know that? How do you then know that the data you're receiving is accurate because they've just had a massive issue, or they've had a cyber attack or a hacking attack? So you suddenly
use Swift, don't you?
We do. It's so
that's the same thing, right? Swift is a trust network.
Yeah. And Swift has its challenges. If you look at some of the cyber losses and fraud losses on Swift, they're huge. And so, but it's one of these things you have to do. What else do you use in the absence of Swift? There's not many alternatives. However, there is alternatives to validating customers. So I think there's things where you're forced to use a service because you're not going to operate internationally then, and you're not going to transfer money across, versus there's things where you've got a choice and you can make a risk-based decision. And as soon as people kind of get nervous about that risk-based decision, if they don't have to do it, they'll avoid it. Why expose yourself to risk unnecessarily? Whereas at the moment, what we're not seeing is customers going, I'm not going to share this data. So what you're not seeing is people kind of voting with their feet, because there's an expectation if you open a bank account, you're going to have to share personal information. that hasn't changed in any degree, whether you open it on a mobile app or in a branch or on the telephone. You fully expect I'm going to share personal data with a bank, but you do that knowing I trust them. Versus if Facebook asked me for my salary details, I wouldn't share it, even if they're a trusted and they're going to be a bank and all the rest of it. So there's already this kind of cultural thing with banking that comes with inherent trust. But I think until it becomes mandated or until it becomes you have no other choice, human instinct, avoid risk, don't run towards it.
Yeah, my natural intention would be, I've already proven it to someone else. Why do I need to prove it again? Why do I need to share my data again and again and again? Exactly the same data, exactly the same thing.
Yeah.
Where I have zero control over it, right? Once that is done. So I'm just multiplying my risk surface. So from an individual point of view, I would say, and also probably from a regulatory point of view, this is going to happen where once you've done it once and you have that proof point, right? Then you don't have to do it again unless something changes, right? So that's I see that is going to happen because it's too big a risk.
Yeah, and that may happen. Yeah, I think that may happen in the future. At the moment, the mass majority of customers, it's an inconvenience for them that they're quite happily overcome. Because I think for those people in the banking industry, we get very excited about this stuff, but for a customer, a bank is an invisible thing. Until it's a problem, and until you go to the ATM and you can't draw money, or your debit card doesn't work, or something happens, it's an invisible thing that you really don't care about. And so it's an inconvenience that happens once, twice every decade. So at the moment, it's not a concern. And from a regulator perspective, the biggest concern right now is, banks, FIs, organizations holding and using the data. Whether they move to you're asking this data as an industry too many times. I think that's a whole another few years before we see that.
And what about the systemic risk that banks carry because of the lack of information? So exposure in the capital markets, where you're building systemic risk and you have just simply a lack of visibility because you don't know, you haven't driven your data supply chain deep enough to actually assess risk properly. But you're happily taking on the risk because you're trading on the margin, right? And you're building leverage, right? So on the retail consumer side, everything is tightly bolted down, but on the institutional side, the systemic risk is built up, which will eventually spill over to the end consumer side. In 2008, we were basically 72 hours away from exactly your scenario where the ATMs will not work anymore.
Yeah, and there's two interesting things that have happened since 2008, which kind of mitigate that to a degree. So the first thing is, you'll probably have noticed, and I don't know what it's like in the States, but a lot of banks in Europe, deleverage their risk in institutional banking. If you look at the scale of, take Barclays, 50% of their income was through institutional banking through their wealth division prior to 2008. Now it's somewhere in the region of less than 10%. The other thing, I think, your point about diluting or that kind of that viral effect on your retail position, is a thing called ring fencing now across Europe. I don't know again if it's in the States, but a retail bank and an institutional bank have to be legally and financially separated. So you can't use capital from one to invest in another. So in theory, every bank, your institutional arm could fail miserably, and it wouldn't affect your retail, and that gets stress tested every year externally. So that was as a direct.
You don't have that. That that was abandoned in
Right.
96, 97,
Right.
when banks, it was in effect, as because of the Great Depression, but that was um, abandoned. Now you just have the stress tests, but you still, retail banks can still have significant
Right.
investment arms. JP Morgan Chase,
Yeah.
Wells Fargo, Bank of America. So, it's like Europe can
Interesting.
do that all at once, right?
Yeah.
If you have systemic contagion
Yeah.
from the US, or from Asia,
Yeah.
for that matter, because there's also not a consistent regulatory environment where that needs to be
Yeah.
separated. It doesn't matter. You're screwed, right?
Yeah, I
So
mean once if we get another 2007, I mean there's only so much tier one ratios and capital can protect you against systemic failure of the whole infrastructure, and the other bit that again I don't know what it's like in the States, but tier one capital ratios in the UK are 15%. So the amount of capital banks hold in Europe and the UK is a ridiculous number. It's a huge amount. And the other bit is they're almost 0% looking to the wholesale market for funding, for lending. It's almost 100% savings to loans. So you're not necessarily relying on the capital market, but if suddenly the Far East went down and the States went down at the same time, again, Europe's tiny in comparison when you look at the total amount of capital. So it's always going to be impacted. I mean, there's nothing you're going to be able to do to protect that.
but you're
All you
still
can do is
happily lending. You're still like happily lending to institutions in the overnight paper market using collateral, even though now held at like a third party bank like Standard. But you're still taking collateral on the word of the other bank without having visibility into the actual quality, because you're still relying on the quality assessment of Moody's and so forth. Again, multi-party coordination, where
yeah,
you have no visibility into whether there is actually correctness in what is done. So the digital supply chain of data
yeah.
is broken, and therefore you are incurring systemic risk because of that behavior.
Yeah, I mean, I can't talk for the industry, Andreas. I'm not that big and smart, but I mean, certainly kind of for the banks I'm aware of, you de-risk that as much as you can. And, to your point about, if you could have more accurate data when it came to capital modeling, and of course you'd take that. But that's a risk you take in the finance industry whenever you go to the wholesale markets, and whenever you do any lending or investing in that space, which goes back to the point, you separate those two parts of the organization. So if one fails, it fails. And the other thing, again, I don't know if this legislation has found its way across the ocean, but we have OCIR and resolution in the UK and Europe as well, which again, what it effectively says is you actually look at your organization and you say, if that limb was to completely fail, right, can you operate, not just from a financial perspective, but your supply chain? What if that whole element of supply chain fails? Could you still operate? What if that whole technical infrastructure that's operated by that supply chain fails? Could you operate? And what they effectively do through these stress testing is they kind of hack off a limb, and they say, could the whole survive if we hacked off that limb? And at what point, when we're hacking off these limbs, are you impacting consumer funds? And that's their concern, which is at what point is there effectively a run on the bank where you're now not able to return all the funds to the customers that you hold. And that's kind of what they get to, and they keep kind of hacking away till they get to a bit, and then they either feel comfortable that you've got it in control, or if you don't, there's plenty of Section 166s, as we call them, across most of the European banks for failures in that end-to-end journey where they can't evidence that, or they're not sufficiently protected against that. And it's one of the key things, the PRA certainly in the UK will talk to us very regularly about, because it's a concern, and the risk you called, Andreas, is one of many risks that could lead to that systemic failure. So it's definitely kind of a front and center. So anything that's in that space that could mitigate that, I don't see anyone saying no to it.
Awesome, awesome. And Ash, I would like you to, there was an anecdote you were saying just before we started the live stream, so which was about doing business and managing risk.
Yes, which one? Sorry, I said too many.
You were saying that what is more important now, as far as you were doing business and making revenue, things were okay in the past.
Yeah, exactly. It's human nature, isn't it? Which is, prior to kind of 2007, 2008, and probably 2012 as well. The focus was kind of driving revenue, and regardless of the risk, because the revenue outweighed the risk in all cases. And that kind of probably plays to your point, Andreas, where, the investment arm of the bank kind of almost protected or hid what was going on in the rest of the organization, whether there was systemic failures in systems, all sorts of things were going on, regulatory fines, all ignored because the income was hiding that from institutional banking. And then 2007, 2008 happened, and then we had some major bank failures across the world. And then suddenly, income, strangely enough, certainly obviously from a regulator perspective, and a lot of the senior boards across most of the banks I'm aware of, the focus is now resilience. The focus is around, consumers, and the income, strangely enough, kind of is secondary. Clearly to shareholders, that's the wrong way around. But for what you see now as to how banks discuss and talk about this, it's all about resilience, because they know how close they were to just completely failing, and as much as kind of corporate memory tends to be short, that certainly kind of left a big scar as 2008, 2007. So and it kind of helps the regulators have not let go since then, because regulators tend to have a spike and then they tend to ease off, but certainly the regulators across Europe have not taken the foot off that ball, and it's a constant discussion around evidencing everything. So income is kind of almost secondary. So people don't chase income. They look for ways to improve control environment with a much more steadier income. And it's about kind of patience and long game rather than trying to chase the big bucks.
Excellent. Today's show could easily be called as a masterclass on risk management for banking. I think it's been awesome having you, Ash. Thank you so much for sharing your thoughts, and we're almost at the top of the hour. So, any parting thoughts, for us, and of course, we would definitely want to have an opportunity to present to you, what Baseline is doing, how far we've come, and what are the capabilities in a more formal setting.
No, I just say I think and I know we've spoken a few times, Samrat, and I think what you guys are doing is kind of certainly interesting. I think there's plenty of kind of opportunities, both from a risk management perspective and just from a commerciality perspective. So I think there's certainly kind of legs in what you're attempting, and I think it's kind of as you said, it's finding opportunities to test this now and prove some of it, and I think the aspiration you're aiming at is the right thing. I think from experience of banking, it's you kind of need to build a story to get people there. I think aspirational ideas are great to have a vision to point to, but if people don't understand the journey there, and they're certainly not as passionate or as knowledgeable as you guys are on this call, it's about how you hook them along that journey. Because at some point when you're talking to CEOs and CROs across the industry, you need to kind of talk their language about what's important to them. And some of the things I kind of talked about earlier on that would be immediate concerns for them, because they all know, anything that is going to improve their risk profile, they are not going to say no to, as long as it overcomes all of the other things. But no, I think thank you again for your time and your questions and your interest.
Thank you very much, Ash. A little bit of chat for the baseline community. So do subscribe to the YouTube channel if you're not already subscribed, and go to baseline-protocol.org to get baseline and get involved. There are two important buttons there: get involved and get baseline. Besides that, the next week, actually the end of this week, I'm going to be in Vietnam, representing Baseline, and talking to builders out there. There are a lot of venture funds which I'm seeing that they're attending that event. A lot of builders as well. So let's hope to get some more attention from that part of the world. And yeah, I will give more updates on the next week's show. To some extent, I would also like to use this opportunity as a call for more speakers, because there is an account aggregators ecosystem being developed in India. The account aggregators are somewhat acting at the same middle layer that we were talking about, where they would interface with the banks, they would help uh, customer onboarding via checks. They could actually just do checks, so they just give responses based on the customer's relationship with a particular bank. So what they're doing is they're saying there's just one customer and 10 banks going after that one guy. So let us be an account aggregator, and in one shot with the customer, they're going to fetch all his banking details and give only the right kind of information to the new bank that the customer is going to. So that's something which is happening. So if any of you could connect me to somebody from the account aggregator ecosystem within India, either from a regulator side or from a provider side, please do. We would love to have them on the Baseline show and discuss opportunities to explore Baseline there. So that's all for today's show. Thank you very much again for everybody who tuned in. I'm gonna bring back the tune that we all love the most. Um, and this is how we sign off for today's show. Thank you very much once again for everybody who tuned in and everybody who's live with us in the studio. See you next week.
Thank you. Why did you show up?